Hello, welcome to Behind the Showcase, your global fashion retail and supply chain podcast. Today, Wednesday, April 22nd. Primark gets cut loose and ABF's number explain why. Moncler gallops past 880 million euro despite a war-hit EMEA. Levi's faces a Dutch courtroom over a Turkish factory. And textile recycling has the capacity. But where are the buyers? I'm Sedat Sezer, breaking down the news and insights you need to start your day. Let's get started. Let me start with the corporate story that's going to reshape how analysts and sourcing teams look at value chain fashion retail. Associated British Foods confirmed yesterday what the market had been speculating about for months. Primark is being spun off. The demerger will be complete by the end of 2027. Two separate London Stock Exchange listings. Food company keeps the ABF name, Primark stands alone. Now its face, this looked like a clean structural decision. Separate a £9.5 billion apparel chain from a food conglomerate. Let each management team focus. Let the market price team properly. Standard corporate logic. But the half-year numbers that ABF released alongside the announcement tell a more complicated story. Group revenue was roughly flat year-on-year at £9.5 billion. Operating profit dropped 7% to £657 million. And the reason cited for that margin compression? Weak European consumer spending. Partly driven by disrupted tourism flows from the ongoing Middle East war. Jefferies analysts flagged that if the conflict extends further, Primark sales face real downside risk. Here's what I'm actually watching. Primark is a volume-first, no online, physical store model, operating in 19 markets with about 490 locations. When you remove it from ABF's balance sheet, you remove the food business ability to cross-subsidize a bad retail quarter. Primark as a standalone company has zero e-commerce revenue to cushion a tough physical retail season. Every store needs to earn its keep from day one of independence, and Shein and Temu are not standing still while Primark works out its capital structure. This connects directly to what's happening on the consumer's demand side in Europe. The Middle East conflict is now producing measurable second-order effects on European retail. Reduced tourism inflows, dampened stamping confidence, softer footfall in the kind of city center and high street locations where Primark operates. If you're a supplier to Primark, watch the demerger timeline closely. A newly independent Primark under pressure will be renegotiating its supply chain for efficiency, not generosity. That conversation is coming. Now let's go to the other end of the retail spectrum, because Moncler just reported numbers that remind you exactly how K-shaped this market has become. Moncler Group Q1 26 consolidated revenue of €808 million, up 6% in reported terms, 12% at constant exchange rates. The Moncler brands alone generated €766 million. Stone Island delivered €114 million, up 11%, marking its third consecutive quarter double-digit growth. The standout regional number, Asia-Pacific, including Japan and Korea, was up 22%. China and Korea led the charge. Meanwhile, EMEA weakened in March, specifically cited as tourism-driven. Same war, same effect. Just hitting different price points. The DTC channel grew 14% to €674 million, and physical store outpaced digital. That last detail matters. People buying Moncler product are choosing to walk into a store. The tagline, experiential dimension of luxury retail, is still real and still converting. If you ask me, the €880 million is the secondary story. The primary story is Stone Island. 3 quarters of double-digit growth, with Asia up to 25% and the America up 24%. Stone Island started as a niche technical outerwear brand, repositioned as a premium streetwear cultural marker. and is now delivering growth numbers that most contemporary fashion brands would sign in blood. That's not just a good brand management, that's pricing power through cultural positioning. And in a market where most brands are fighting over the same anxious middle income consumer, pricing power is the asset that survives. This brings to a story that sits at the intersection of global compliance risk and supply chain governance, and it landed yesterday in an Amsterdam courtroom. Clean Clothes campaign filed suits against Levi's, four Dutch consumers as plaintiffs. The allegations: Levi's marked itself as an ethical, responsible producer, while its supplier Özak Tekstil in Turkey was engaged in union suppression and mass dismissals of union members. A 2024 Worker Rights Consortium investigation found violations of Turkish labor law, international labor standards, and Levi's own supplier code of conduct. Özak subsequently prepared a corrective action plan. The dismissed union workers were not reinstated. Levi's denies wrongdoing. The lawsuit is filed under Dutch consumer protection law. The argument: consumers were misled by Levi's brand messaging on ethical production. The legal remedy sought is that Levi's must correct that lie until dismissed workers are reinstated. Now I want to separate two things here. The legal outcome will take time, and Dutch courts will decide what they decide. But the structural signal in this case is independent of the verdict. What this case represents is a new liability model in Europe. The EU's Greenwashing Directive is moving through implementation. Individuals now has expanding standing to sue brands for misleading sustainability claims. What used to be a reputational risk, a campaign, a headline, a bad press cycle, is now a litigation risk with a court filing date. And the target is not just the brand's environmental claims, it's the social claims, labor rights in supplier factories. We treat our workers well messaging on a brand's website. All of it is now potentially legally exposed. I've been watching compliance pressure built in this industry for over 25 years. And here's what this case signals clearly. The days when a brand could point to a supplier code of conduct and the call conversation closed are over. Auditing a supplier once a year doesn't insulate you from a Dutch consumer lawsuit. For any global brand sourcing from markets with complex industrial relations, Turkey, Bangladesh, Vietnam, this case is a wake-up call. Map your supplier label exposure now, not when the feeling arrives. Same pattern, different geography. US retail sales for March came in at 1.7% month-on-month, ahead expectations. On the surface, consumer spending looked resilient. But here's the detail that matters. The headline numbers was largely driven by higher gasoline prices. Energy-inflated retail spend is not the same thing as discretionary demand recovery. When you strip out the fuel, the picture is considerably more cautious. This connects directly to what Lululemon is doing in Mexico. While the US numbers carry as asterisks, Lululemon is making a straightforward bet on geography. North American Q4 revenue fell 4% year on year, but international revenue was up 17%. The response? Launch e-commerce in Mexico, open 8 new stores in the Mexican markets in fiscal year. 6 new country entries in parallel: Greece, India, Hungary, Romania, Poland, Austria. This is a company that looked at the domestic ceiling and decided the growth floor is elsewhere. Let me close with a story that sits outside the immediate financial cycle, but is arguably the most structurally significant for this industry over the next decades. Europe's textile-to-textile recycling sector is recovering. New regulatory frameworks are driving investment back into recycling capacity. Infrastructure is being rebuilt. The problem is demand. Brands are not buying. The technology is proven, the capacity is being built, but the purchase commitments from fashion companies that would actually make this sector commercially viable at scale, those are not materializing fast enough. Here's what this tells me. The circular transition in textiles is not stalled on the supply side. It's stalled on the buy side. Brands are waiting for the regulatory pressure to force the hand of the competitor before they commit. Everyone wants to be a fast follower on recycled fiber purchasing, not a first mover. And in the meantime, the recycling companies that built the capacity on the promise of brand demand are running thin on patience and margins. If you are in procurement at a major apparel brand, this is the moment to move. The window to build supplier relationships with recyclers before everyone else races is right now. The main question I want to leave you with today is, as Primark prepares the standalone, without the food business cushion, without e-commerce, and facing Shein, a war-damped Europe consumer, is the demerger a liberation, or does it remove the last safety net at exactly the wrong moment? That's all for today's analysis. To make sure you never miss the insights behind the number, hit subscribe wherever you get your podcast. I'm Sedat Sezer. Thanks for tuning in. I'll see you tomorrow. Until then, stay ahead of the curve.